And this video may have went well with the last video I just did, but this one is specific to silver. Which is why I decided I'm doing a separate video on silver, because people tend to ask me from time to time, why do you talk more, why are you more into silver than gold, or why do you always talk about silver more than gold? You always talk about stacking silver, yada yada yada, instead of gold. And I always say, when the time comes and the prices rise, and they are going to, you're going to be real happy with gold. But due to the 70-to-1 ratio, that gold to silver ratio we have right now, when historically should be 16-to-1 or maybe even 20-to-1, you're going to be real happy with what silver does. I think there's more potential upside for silver specifically for that reason alone. That's one of the largest reasons. History, and I mean thousands of years of history, have set that price. Only in very recent history, as in I think from 1960 something forward, did that gold to silver ratio start to go wonky from 16-to-1 or whatever, 20-to-1 roughly, to then where it's at today, these days, 70 plus or whatever it is, roughly 70-to-1. If that came down, if it was 80-to-1, again for easy math, and it came down tomorrow to 20-to-1, that's 4 times the price instantly. 50-something bucks instantly. Boom, here you go. Whoa, what just happened, right? That's one of the main reasons. Another reason is, simply, silver is the poor man's gold. You can buy a lot more silver than you can gold. Not to mention, again, with the 70-to-1 ratio, you can definitely buy a lot more silver than gold. So if that ratio comes down, your silver stack value goes up potentially exponentially. But I never did this, as I said a million times, to just only do this to tell people how to get rich someday. No, this was never about getting rich. It was always about protecting one's wealth. And the longer they take to deal with these, debt problems, derivative problems, and the whole 9 yards, the longer you have to keep stacking. So, an interesting DeviantInvestor.com. DeviantInvestor.com. This is a very interesting article. Silver prices and interest rates. A 200-year look through a chart, I'm going to show you in a minute, of what happens to the price of silver when interest rates go up from wherever they are. So, matter of fact, right off the bat, how about we go right into this chart. Here we go. 200 years of U.S. interest rates, average 5.18%. Going back to, roughly 1800, 1798, whatever. When interest rates go up, right? Interest rates average 5.18. Examining the above chart, interest rates for 200 years, rates rise and fall in long cycles, 20 to 40 years from a peak to a trough. Important highs occurred in 1920 and 1981. Important lows occurred 1946 and probably, he says, probably 2016. So, what do we have? Hold on, Gary Christensen. This isn't the same guy I think it is. No. Not. There was a shill Christensen something. It's not him. This is not the guy. Definitely not him. So important lows occurred in 1946 and probably 2016, he says. Now, if you look at silver prices right now and where they've been, in 2015, 14, 13, 12, and again, they can slam it one more time. They could certainly do it. But we're got to be close, if not at the lows right now. I mean, I just said this the other day that I don't know if it's going to do much more at all. But when you have a club that can do anything with the press of a button on a keyboard or an algorithm that runs by itself, you can push the price anywhere you want on those paper markets, which are what sets the actual price. So he says there's 20 and 40-year cycles from peak to trough. So examine the chart, which let me get back to my normal Realist News fake background screen. Examine the chart of annual silver prices since 1913 on a log scale. The upward trend in silver prices is clear and will continue as long as debt is increasing in our fiat currency system. So let's take a peek at that second chart. January of 2013. This is 100 years. Oh, so 1913. Is that what we're looking at? Wait a minute. Silver annual average 100 years log scale. Yep, $1, $2, whatever, 18, 20, 50. All right, so this was back in 78, 1980, 81, which again, we had, at that point, what, $50 silver. I'm not sure if this is just not inflation adjusted or whatever, because this is showing $16. And it should be more like 50 up here. But nonetheless, this chart, 88, 90s, early 2000s, we had $4 or $5 silver, which was true. 2008, it 2011, it jumped way up. As you know, it rode a horse way up there before jumping off the horse, so to speak. So he says highs, rates, 1920, silver, 1990, interest rates, both of these are interest rates, 81 to 1980. And then lows, interest rates, same thing, 1946, 1932, and 1941. And then low interest rates, 2016, silver, 2015. So interest rates rose approximately 35 years from 1946 to 1981 and fell for 35 years from 1981 to 2016. These are interest rates we're talking about. Silver prices could rise for several decades, along with interest rates. As the dollar is devalued further, silver is aggressively used for industrial applications, investment demand increases, and perhaps the world is forced to return to a monetary system tied more closely to gold and silver. Which, if you've seen the front cover of the 1988 Economist magazine, that I've said 100,000 times now, the Clubs magazine, it shows a fiery phoenix coming up from the ashes of paper dollars, from US dollars in there to other currencies across the world, burning on fire, the rising phoenix with a giant, not necessarily a giant, but a big gold coin around its neck saying, get ready for a new currency, or new world currency, whatever it said, in 2018. And again, had a big giant gold coin on its neck with that year on there, 2018. We're talking 2 years from now. Not even. It's 2017. It's practically 1 year from now, depending on what part of 2018 it actually is in. 1 to 2 years, we'll call it. So I'm banking on the fact that we're going to go back to a financial system backed by some kind of asset. History tells us what that asset is: precious metals. Okay. Rising interest rates. We also know that interest rates are the cost of money and have been steadily pushed lower for 35 years by government and central bank actions. Further, the bond market rises as interest rates fall. Good times for Wall Street. And falls as interest rates rise. Higher rates mean the 200 trillion or so of debt is more costly to service. We know it will never be paid back in current dollars, but interest to service the debt is more onerous. Budgets are squeezed, projects are curtailed, weak businesses go bankrupt, stock buybacks are reduced, and all those derivatives that are tied to interest rates, well, it won't be good for many of them. The resolution: let it all crash. Admit the governments of the world have no intention of repaying the debt, at least since 2008. Let the depression begin, destroy economies, governments, businesses, and millions of lives, including the politicians and central bankers who created unsustainable systems and encourage deficit spending, or monetize debt, fire up the printing presses, launch the Bernanke helicopters, and blame someone for the inflationary consequences later. I wonder which one they'll choose. What politician, banker, Wall Street CEO, central banker, or corporation CEO will actually choose the crash option? Hence, expect the inflation option. For review, in 1913, a dollar bought almost 1/20th of an ounce of gold, 8 gallons of gasoline, and 14 loaves of bread. Okay? 1913, the year the Federal Reserve actually created, a single dollar, bought almost 1/20th of an ounce of gold. In other words, gold was $20, and $1 would buy 1/20th, okay? 8 gallons of gas for $1, and 14 loaves of bread for $1. Ooh. Today, we all know the devalued dollars by much less. In round numbers, our politicians and central bankers have devalued the dollar by perhaps 98%. Expect the devaluation of all fiat currencies to accelerate. During the 8 long years of the Obama administration, total official U.S. government debt has approximately doubled, as I've covered for my peeps, about 479 times. Doubled from about 10 trillion to about 20 trillion. Expect more debt, lots more debt, lots more debt. What does this suggest about silver prices? More debt means more dollars are in circulation, and that means erratically higher prices for most items, including bread, energy, healthcare, and silver. Speaking of which, can I interject within my interjection? Guy at work, coworker came to me today, older guy. I think he's probably in his safely mid-50s, possibly late 50s. Hey, man, can you believe this? What? I just found out what my health care is going to be. And it's gone up a lot. It has gone up a lot, man. I cannot believe this. I am now having to pay an entire paycheck for my health care. And he said, it's just for me. Not my family, not my wife, it's just me. For myself, I have to use one of my entire paychecks to pay for it. That's what it cost me now. And it went up a lot. I said, oh, well, you can do one thing that may help that. I said, listen, we have company health insurance, and our company actually helps pay some of your bill, as an incentive to work for the company. And I said, one time I went and got private insurance myself, just to quote, and it was significantly, shockingly lower. Like, I want to say, company, how much do I have to pay a month? And this was a few years ago, by the way. $238 for yourself, Jason Ipfor. Oh. Let me go browse around the private market. $108, I think, was my total. And I sent it to our HR girl. She said, this is actually a little bit better as far as what it covers and fees and everything. Not including the cheap price. Just what it covers, the type of insurance, whatever. The plan. Do you want the blue plan, the green plan, the gold plan? That. This is actually a little better than what we offer. I said, well, this is more than half. So we had a meeting recently after that happened, after I was browsing around. And it was about healthcare and to answer questions and what. And I said, I got a question. Go ahead. I checked my cost for healthcare. Is it my understanding that the company I work for, you are actually paying? So whatever I am told from HR, this is what I would pay monthly, or how much would come out of my weekly checks. You're actually pitching in, and that's what the result is after you pitched in to. Yes, that's correct. This is insane. I said that. I just found private insurance for less than half of that fee. I can't understand why it's like that. Do you know of a reason why this is the case? And she said yes. Because when we get company insurance, they don't deny anybody in the company. Everybody's approved. Well, we do have one person there, particular, not to pick on anybody, because life is life. Things happen to people, whatever. Couldn't get her husband covered unless they had that insurance. So she can never leave this company in order for him to get insurance, basically, at the time. And that's not necessarily why our rates went up, but that is why our rates went up. Okay? So I am pitching in forcefully, essentially, by paying the full amount to help someone else get health care that could never get it by themselves. And since the insurance company has to cover everybody, that's why we're all paying more than we need to. So I said, thanks, but no thanks. And I'm not getting any health insurance. That was a few years ago. And as I told you, I got health insurance this year only to deal with my foot problem. And fingers crossed, it might actually be fixed. But anyway, so I'm seeing this right now. Higher cost for healthcare. Bingo. I just had a story this morning about a poor guy at work. Oh my God, an entire paycheck is going to go just for myself for health insurance. I told him that story and I said, look, go find insurance on your own and see if you can get a better deal. Okay? Just go and see. Now, I know with the whole Obamacare thing now, no one can be denied. Not sure if we'll have too much good luck or not, but I'm pretty sure he can find a better plan, honestly. Back onto the subject here. So, number one, more debt means more dollars are in circulation, and that means erratically higher prices for most items, including bread, energy, healthcare, and silver. Number two, bond monetization, or printing dollars, and helicopter money will suggest to everyone, eventually, that the dollar is not a reliable store of value and has not been since 1913. When that realization is finally common knowledge, people will act to protect their wealth and purchasing power. Silver and gold will perform better than crashing bonds, overvalued stocks, and promises from politicians. Number three, silver and gold are insurance against crashing markets, central banks, and government manipulations, devaluing currencies, collapsing Ponzi schemes in debt and credit currency markets, and more. Number four, the dollar has lost about 98% of its value in 100 years. Silver and gold have, on average, retained their value. Expect their current low prices to spike higher as fiat currency declines towards its intrinsic value. So let's look at $1,200 gold right now. Okay? Speaking of holding its value. They said you could buy 8 gallons of gas and how much? 13 loaves of bread? What was that? Go back up, find where that was. Well, I don't even see. Okay, yeah. 8 gallons of gas, 14 loaves of bread. 1/20th of an ounce of gold is what that purchased. Remember? So 20 times 8 gallons of gas, in other words, a full ounce of gold. 20 times 8 would be 160 gallons of gas. 1 ounce of gold back then would buy you 160 gallons of gas. Okay, so today's dollars, and we're going to just round off because I can get gas right now for about $2 a gallon. 1,200 divided, this is easy math, by 2. I don't even know why I'm typing this, but 600. $1,200 divided by $2 a gallon, 600. I could buy 600 gallons of gas right now. I could buy 600 gallons of gas for 1 full coin, which back then I could only buy 160 gallons. So at $1,200 gold, boy oh boy, is it holding its value of what it could buy. Just like they said in the old Roman days, you could buy, like today, you could buy a nice business suit, tie, the whole 9 yards, nice pair of shoes, all of it. Get suited up. Well, guess what? Back in 2,000 years ago, Roman days, Roman Empire days, a gold coin could do the same exact thing. Could pimp a man out, Rome style, in your little curtain-looking garments. But back then, that was the deal. You know, there was no Nike. Just do it. No, 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 no. Don't do it. Put on this curtain. Be a man. Anyways, I believe my point has been made. Take care.